Welcome to the first ever episode of All In Advisor Access. I'm Blair Barton, Senior Financial Advisor and CEO of Auxiliary I&I. And every week I will be joined by Mr. Eduardo Ernesto Donen, Century 21, Eddie Donen, the Eddie Donen team. Welcome, my friend.
Well, thank you so much, man. Well, I'm pretty excited to be a part of this. I'm a real estate broker with Century 21 Heritage. I've been doing this for 14 years. I've known Blair for, I think, almost 20 years now. Oh, no, I'm not that old. 16 years. Funny story, we used to work together. We were co-workers. I used to work at Moore's Clothing for Men. That's where I met Blair. And he's always been a hardworking guy, very good with people, very honest, very forthcoming. And we've always been in touch. I've helped him with a few of his deals over the past. And once he jumped into financial industries, I figured there was nobody better to partner up with and have my business with him as well. And that's how we've kind of been brainstorming for the last couple of years and going back and forth doing business together. And this initiative of the podcast, which I think it's amazing because we can really bring different perspectives from the financial world, from the real estate world. I mean, everyone has questions, right? And that's what we're here for, to answer them and to give a real raw perspective. Like what I said to Blair when we're thinking about this, I don't want to be scripting things. I don't want to be BSing people. I want to have, the real facts and people can pretty much just ask anything that they want to know.
Well, absolutely. And that's, going back with you, 16 years now. Obviously working with Eddie is, super cerebral guy. He was, you're talking about you're going to be a psychiatrist, right? And,
yeah.
Found real estate and, you're one of the hardest working, most dedicated people to your craft that I know. And, I've bought, sold, rented, done lots of projects with Eddie. Eddie's a client of mine as well. Super excited to be doing this with you. It's going to be a lot of fun. And the whole point of this podcast and the reason we named it, Advisor Access is because when you're working with an advisor, you have access to a whole network of professionals. Okay. And obviously that goes from real estate agents to different kinds of brokers, different kinds of insurance people, and someone like the gentleman that we have guesting with us today, George from HomeEquity Bank. I'm not going to take a stab at your last name, George, but you go ahead and introduce yourself.
Zabarelos.
Yeah. Got it.
I think that's the Spanish in Eddie coming out. Just pronounce every word and get comfortable with the 4 syllables, and it tends to flow off the tongue quite easily. But Eddie, it's a pleasure to meet you, and Blair, thank you for having me on today. Folks, speaking for myself really quick, I've been in financial services since the early 90s. I've been dealing exclusively with financial advisors like Blair ever since. Some people call me a wholesaler. I like to think of myself as a provider of value when it comes to select services that I'm able to offer. And at the end of the day, the chip reverse mortgage is simply one golden tipped arrow, if you will, in Blair's quiver of solutions. I'm one solution of many that Blair is able to bring to the table to help you solve any issues or solutions you need to bring to the table. But real quick, a lot of people ask, what is a reverse mortgage? So let me just be really quick about that, because not only do I work with professionals like Blair, but I also have clients like Eddie as well. And we'll get into some of these case studies later. In a nutshell, a reverse mortgage is a way for Canadian homeowners 55 or older to turn up to 55% of the value of their home into tax-free cash. In many ways, it lets Canadians retire safely and securely in the home they love. In essence, it's a loan secured against the value of the home. And unlike a traditional home equity line of credit or conventional mortgage, there are no monthly mortgage payments required for as long as you live in the home. In a nutshell, that's what we do. And I've partnered with Blair to support his clients when the need arises. Blair?
Well, absolutely. And, we've been able to work together on a number of solutions for people. And, just before Christmas, we actually were able to change a family's life. And, the client called me, thanked me crying that we're able to save their Christmas. And, they owned their home outright. And George was able to provide them with service in a quick turnaround and, instantly became, a partner for life. And George and I, we keep in touch often. We work together. Very excited to have you in today. And we got a few questions that we put out to our followers, asking them to, what kind of things would they like to ask George and just, some things about the HomeEquity Bank and chip reverse mortgage. And I'll start with a question, and this is from Justin in Coburg. He says, I know your program allows for those homeowners over 55 to participate. Is that typical? How much money, as an example, can a 55-year-old get access to?
Yeah, no, that's a good question. And in order to qualify for the chip reverse mortgage, Blair, as you know, Canadians have to be 55 years of age or older. Now, the reality is that the average age of a client that a financial professional like Blair refers to us at the bank is about 71, 72 years old. And the reason that is the older a Canadian is, the more money they potentially qualify for when they apply for the chip reverse mortgage. And that's simply a function of what our actuaries call expected occupancy time in the home. But when you're 55, your loan to value might be around 14, 15%. When you jump to 70, 75, the loan to value increases to closer to 44%. So it really does depend on not only the client's age, but the type of home they have, i.e. Single detached or detached home, coupled with the location. I think Eddie can speak much better than I can about how important location is as it relates to real estate valuations.
Yeah, 100%, George. And that's why when you're making a purchase, and specifically depends on the client's stage in life, right? Somebody Blair's age might be buying a home that he's probably going to move in for 2, 3, 4, 5 years and upsize, downsize, move out of the, you never know what's going to happen, right? But when somebody's looking for the home and they tell me, listen, I'm going to stay here until I die, then you really have to be key on the location, because I mean, it's an investment, as you said.
Yeah,
and
yeah.
That's one thing. I did have a question for you, George, just off the topic here right now.
Yeah,
sure. What's the minimum loan to value that somebody needs to have to qualify? I know you guys will lend up to 55%, but is there a minimum requirement? Can somebody come in, let's say, with 30% and then go up to that 55%?
Well, as they age, not only does the increase in years in their life increase the potential loan to value, but also as they age, typically the home appreciates in value as well.
Sure.
And it depends on where your location is. I was reading in the paper the other day that over the last year, we've seen anywhere from 11 to 13% growth ever since the start of the pandemic. So, I have had situations where somebody might have engaged in a chip reverse mortgage when they were a lot younger. 10, 15 years later, the house is appreciated in value. They've matured in age. So we're able to actually refinance those deals as well. And Eddie, I want to mention something. I know that we haven't worked on this as of yet, but as a result of this pandemic, we are finding that a lot of older Canadians, at first, before the pandemic, they were thinking about moving. Now they're sitting still. They're like, you know what? I don't want to move out of my home. And one thing we've been able to do is we've been able to help older Canadians provide chip reverse mortgage loans to their children in order to help them get that much needed down payment of 20% so that they can qualify for much lower mortgage rates. So I hope that answers your question, Eddie.
Yeah, it does. And to jump in on that, I don't know the exact stats because it's really hard to figure them, but I would say a majority of younger buyers under the age of 35, they require parental help one way or another.
Right.
Unless they were very diligent, they invested in their early 20s when the properties were really, really cheap, and now they built up that equity. But the majority of them haven't. And if they're a first-time home buyer, with the down payment requirements right now, with the qualifying criteria, it's not only down payment, it's the income that you need right now to carry a mortgage, CMHC regulations. It's virtually impossible. If you're looking at an average sale price of, about $900,000 in GTA, you would potentially need about $90,000 cash plus closing costs. It adds up, and not a lot of people with the high rent prices are able to put away that much money, right, Blair, every single month to come up with $90,000. I'm sure the plans that you do for younger couples, I mean, they might be able to save $300, $500, maybe $1,000 a month. But even if it's $1,000 a month, which I think is good, that's only $12,000 a year. Take them about 7, 8 years to save for a down payment, and at that point they keep on, the prices keep on going up. It's a catch-up game that they're never going to win. So I have had a lot of clients that they go to their parents, they might not have the cash, but they use the equity in their home, through normal methods via refinance or a second mortgage. But the reverse mortgage has always been very, very interesting to me, because I'm a proponent of, if you can keep the house, right? If you can keep the house, always keep it. It's an asset that is usually going to go up. It goes in waves, but in reality, the projection is always like this. Yeah. So if your parents, my parents, they can afford to keep their house, they can afford to keep their payments, why would they sell it?
Yeah,
Especially
no, exactly.
with the rent prices right now.
That's exactly it, right? And to your guys' point, you know, there's so much versatility with able to get the access out of the, you know, get the income from your house that you own. And you know, a lot of the people that I've been speaking with anyway have owned their home for a long time and had it paid off for a long time, but they don't have a lot of money. You know, they didn't have someone like myself to you know, kickstart their retirement income and you know, make a plan. So what a lot of people have been doing, I found, you know, working on some case studies with George, is they'll take the money out of the chip reverse mortgage, and they will invest some of that money to kickstart the retirement right away. Instead of contributing a little bit a month, they'll just put a big lump sum in there. So it just kickstarts it. They can start pulling from that when they're ready to retire. And typically, because the value and the equity of their house has gone up so much, they're still able to, you know, help fund their children with a down payment.
Yeah.
It doesn't, you know, it doesn't hurt the cash flow too much, because like George mentioned earlier, is there's no monthly minimum or maximum that you have to pay. There's nothing that you have to do right away. It just takes the equity of your home, and guess what? The equity is going to keep going up in your house.
Yeah, exactly. And it's all about, you know, thinking differently as it relates to inheritances. You know, a lot of people are going, well, you know, I got to wait till my parents unfortunately pass away. This is a way to turn a death benefit into a living benefit, a living inheritance, so to speak. And Blair, I think you can attest to this. It's also a strategy for older Canadians to allow them to preserve their liquid portfolio investments with you. Instead of them tapping into those portfolios, which trigger tax consequences, as you know, to help their children, tapping into the equity of their home in a tax-free cash flow fashion and allowing that home to continue to grow in appreciation year over year, I think makes a lot of sense. And I think you said it, Eddie. Why sell off an appreciating asset if you can use a strategy like the chip reverse mortgage to do so? And then, of course, bringing the three of us together, Blair, Eddie, and myself, we work together to help those Canadians. But at the end of the day, the quarterback, if you will, is Blair. He quarterbacks all of this activity, and we're simply a couple of his vendors that help his clients achieve those financial goals.
Yeah, 1,000%. And especially, George, on the point that when somebody's selling a home, in this case, principal residence, we're talking about, I mean, it's tax-free, but with the way the market is right now, and I'm going to touch a little bit on the market later on, but the way the market is right now, inventory is so low. So let's say we have a Canadian family that's been living on their home for 30 years. It might be worth $1 million right now in the outskirts, maybe in Barrie, in Innisfil. There's houses that are easily worth about $1 million. So, you know, they're seeing, wow, I have $1 million right now that I can spend. But in reality, what are they going to buy? Right now, we have what I would call somewhat of a crisis in the market. There's no inventory. So if somebody's going to go sell off their $1 million home to buy a $900,000 home, that really doesn't do much for them, right? After fees, after commission, after land transfer tax, they're not as liquid. So the dream that a lot of Canadians had before, which was downsizing, you know, moving out of the city, moving out, well, prices are so high pretty much across the board that it doesn't really make sense. It makes sense to move for a lot of people for different reasons. They might want to upsize, they might actually want to change locations, but for financial purposes, they're still going to need a place to live. You know, it makes no sense to sell their home and go rent, which I see a lot of people do that, because that money will run like this. Rentals are so high right now, which is better if you can keep an asset which you can potentially pass on to your kids. It's growing in value. Why would you sell it and go rent something? So I think that's why the reverse mortgage is so attractive. And the main thing is the majority of Canadians that are going to be reaching out to Blair, are going to be reaching out to you, George. It's because they're probably having cash flow problems. They need to get funds. And their first idea is, well, I'll sell the house, right? But they don't know they have access. Tons of people don't know they have access to this, right? They're afraid to go to the bank because sure, they can get a mortgage. They can qualify an equity loan. You know, they can get, let's say on that $1 million home we were talking about, they can get $350,000 easy, right? But they're going to start making payments on it right now. And that's the last thing they want to do.
Yeah. And I know, Blair, you know, you and I worked together just recently on that last case. And I know we made the Christmas for that family that you introduced me to, and I was really happy to do so. But, you know, at the end of the day, the chip reverse mortgage is something that I would encourage all people to contact Blair Barton about. I know we have a 1-800 number, and we do receive thousands of calls a month from Canadians right across this great land. But in order to take the level of service to the next level, provide white glove service, and also provide preferred rates, Going through a professional like Blair Barton or Eddie is the best way to approach your desire to learn more about the chip reverse mortgage and whether or not it makes sense for your unique situation. Blair,
Well,
you want to?
that's just the thing, right? Professionals working with professionals, we're stronger together, right? Or, we all can't be licensed to do everything because as well, it's not allowed, and two, it's, all these different positions that we hold, it's a full-time job. I'm clocking in myself, I don't try not to pay attention to how often I work, but you're looking, 60 hours a week. The first thing you think about when you wake up in the morning, last thing before you go to bed, different cases are going through your mind, different marketing schemes, all these different things that you want to, talk about. George, so I have to ask you a question from Jennifer on LinkedIn because, when she heard that we're talking about this, she was very adamant. And this is great because it's coming from someone that's in the same field as me. And when you work in mutual funds, you know how strict compliance is. And so that's always something here. So now compliance is always a big concern. Can you chat a little bit about some of the protections HomeEquity Bank takes to a certain reverse mortgage is appropriate for a particular client?
Yeah, no, by all means, I'd love to answer that question. And one of the differences between CHIP and other traditional lenders like a line of credit, a home equity line of credit, is we do not look at income to determine whether or not somebody qualifies. And that's one of the reasons why a lot of older Canadians come to us. They might want to help their children with the mortgage, but they're not able to obtain a mortgage because they're no longer generating employment income like they used to before. We're a solely focused equity lender, if you will, based on the valuation of the home. And we're also a Schedule 1 bank. So I'm going to touch on two things as it relates to answering your question, Blair. A lot of people don't realize that HomeEquity Bank has actually been around for close to 35 years. We're also a Schedule 1 bank, which means we're regulated just like the Big Five from the federal government vis-a-vis the Canadian Bank Act. And we're also regulated by the Office of the Superintendent of Financial Institutions. I know Eddie's familiar with OSFI because they were the ones that introduced the mortgage stress test rules back in January of 2018. And Eddie, I know you want to talk more about that, but let me quickly end this as it relates to compliance. And Blair, you're familiar with this because of all the cases we've done together, but there is a process involved in the CHIP reverse mortgage application, obviously. The final event that takes place before we, as a Schedule 1 bank, are able to provide funding and electronically fund transfer their tax-free money to their bank account is the homeowners have to sit with a lawyer. We call it an ILA, an independent legal advice meeting, where the lawyer highlights everything within the reverse mortgage contract, make sure that the homeowner understands everything line by line. And only after the lawyer feels comfortable that it's a fair deal, they will then sign off on the mortgage, the CHIP reverse mortgage documents, send them back to our office, at which point only then and then can we release the funds. So compliance is important. We bring lawyers into the equation because at the end of the day, it's all about keeping your client, Blair, the homeowner, safe.
Absolutely. George, I had a quick question on the loan to value amount.
Yeah.
Okay, so we're saying 55%. So let's say we have a couple right now that's 60 years old, they have the house paid for. Right now they're currently working, right? But they do want to give that down payment to their kids. They want to pull up maybe, let's say $100,000 right now and give that down payment, right? So they could easily come to you guys that they don't have to go full out 55% right away or 40%. What's the minimum amount that can be loaned?
Well, the minimum is about 11 to 14%, but that's for somebody who's about 55 years old when they first qualify. We don't see many cases like that.
Right.
But we do see a lot of cases in the 60s, mid 60s, and early 70s. So in your situation, early 60s, we're looking anywhere from 20 to 30% loan to value. Right. And if we're right, we know we're right. I'm just going to round up. The average price for a single detached home in the Greater Toronto area is about $1 million, right? It's 900,000. We'll just say $1 million. So if they do qualify for 20%, let's say, that means they could access $200,000 of cash-free income, which they can then gift to their children, with thereby allowing them to make that crucial down payment on the first home they ever purchased. As a matter of fact, some children actually want to eventually pay the parents back. So what they do is they wait for their own new home that they just bought with the help of their parents to appreciate in value 5, 6, 7 years. Now they're younger, they're working. We'd like to think that their incomes are growing.
Right.
Parents, they're not generating income. So after about a 5, 6, 7 year period, they may want to contact you again, Eddie, to go, you know what? And Blair as well. Our home has grown in value now. Why don't we refinance it? Take the excess cash that we receive from the refinancing and give it back to our folks so they can reinvest it again with Blair, thereby giving them more liquid investments that they can live on during their retirement years. So that's another strategy that I know Blair and I have discussed, and I wanted to share that with Eddie as well.
One other question off of this, and I know Blair has more questions from people that have seen the podcast before and the advertising I want to ask you, but can somebody potentially double dip? We're talking about equity appreciating every year. So let's say 20% last year, year over year. So let's say somebody that came to you and did a reverse mortgage 5 years ago at age 65, and now wants to pull more money out, let's say for their second kid. Is that a possibility, or is it a one-shot thing?
Well, yes, it is a possibility. You know, as a matter of fact, in some cases, homeowners get qualified for an amount that's more than they need, right?
Correct.
So somebody could qualify for 300,000-400,000, let's say, for example, but they only require maybe a couple of $100,000, right?
Right.
They don't need to take the full amount that they qualify for out. They could just take the amount they need, leave the rest behind as a rainy day slush fund, if you will, that they can tap into at a later point in time. As I mentioned earlier, very similar to a HELOC, a home equity line of credit, with tremendous differences. The main one being, with a chip reverse mortgage, you're not required to make monthly payments if you don't want to. Another good thing about chip is once they qualify and they get set up, it's theirs for life as long as they remain in the home. We're not able to call that loan on them. I have seen situations with HELOCs and lines of credit where the bank is able to unilaterally call the loan on the homeowner and make them pay the outstanding balance for whatever reason the bank wants, right? So I'm sure you've seen those as well. And I'm sure, Blair, you've seen some of those instances as well yourself, given all the clients you deal with.
Absolutely. Yeah, absolutely. George, I want to get to one more question that I actually I have, and I think that people watching would like to know. And then you know, we're running out of time here. So, has the pandemic revealed any new forms of demand for the chip for high net worth clients? And in what kind of way? And
yes.
Read a little bit further on that.
Yeah, you'd be surprised. You know, a lot of people, when they first hear about chip reverse mortgage, they may be bombarded with a number of misconceptions. Unfortunately, a lot of those misconceptions come from our cousins to the south in the United States of America, which has a completely different banking system than we do. And you know, one of the big differences is here in Canada, we never take title on the home. Title always remains in the homeowner's name. We're just a first charge against the home, just like a regular mortgage. So yeah, believe it or not, we've seen a number of instances, and as a matter of fact, we're working on a case right now where we're looking at a $10 million home, right? So you've got a lot of high net worth individuals out there, small and medium-sized business owners. They're extremely wealthy. They've got a lot of equity built up in their homes and have assets invested with you, Blair. But when you're a private business and you've got a good accountant who's very good at creative accounting in a legal fashion, a lot of these high net worth individuals don't claim a lot of income on an annual basis in order to minimize their tax burden. And you know what? If you can do it, why not? If it's legal, take advantage of, you know, the various ways to save taxes. So we just funded one not too long ago. It was a Chinese Canadian couple, very high net worth, required access to credit, a loan, but would never get qualified because they weren't reporting the amount of income that a traditional bank would be comfortable with. We came into the equation, and as I mentioned earlier, income is not a requirement in order to qualify for the chip reverse mortgage. We valued their home at about $10 million, as I mentioned earlier, and as a result, their loan to value was about 30%. So they were closer to 65 years old, and we were able to basically fund them $3 million. Now,
wow.
They didn't need to take it all, but they did, and they're using it effectively with their advisor in terms of what they need to do with it. So yeah, $3 million loan was one of the biggest we've done in history. So to answer your question clearly, our business has actually gone like this since the beginning of the pandemic, and we're happy to be able to help Canadians any way we can.
Absolutely, and then I think you know that could be said for all of us in the industry. People have some time on their hands to act now, build plans, invest in property, and definitely get some equity out. Eddie, anything you'd like to ask George before we sign off?
Yeah. So going back on that, it blows my mind. $3 million. So what's the maximum that you guys would, like, you've seen? What's the maximum it goes out to?
It doesn't matter. It doesn't matter. It's all
Pure
a function.
equity lending, right?
Pure equity lending. It's all a function of the valuation of their primary home. As a matter of fact, we could even take it to the next level. We've had situations where Canadian homeowners that Blair's referred me and other referral partners I deal with have referred to me, and we've had situations where they have a principal home, but they also have an investment property and a cottage. So we've been very innovative over the last 35 years that we've been in business, and we're always trying to make it easier for Canadians to get as much loan to value as they want. Correspondingly, we're actually able to blanket up to 3 properties. So
Wow.
we could blanket the residential, cottage, investment property, increase their loan to value. And as I mentioned, you know, Blair, I know you got a lot of high net worth clients with very large portfolios with you. And you know, the last thing they want to do is start dipping into their registered or non-registered accounts. This is a far better strategy to help them with their needs. In some cases, they may want to buy an investment property and don't want to redeem the investment funds they have with you. Tipping into the chip reverse mortgage and then speaking with Eddie is a way to accomplish that end. Using chip to purchase another investment property, get the renters in, and hopefully allow it to carry itself as such.
Or even cash flow. I mean, George, that's something that I didn't know. I thought you guys would only do principal residence. I didn't think you would be blanketing it, and that's very, very good to know, because a lot of people might not have enough equity on that first home, but they have properties that are paid off, or vice versa. They can if you have 3-4 properties, you have a high net worth usually. You can take money.
Exactly. And I know, Blair, there's this other case we're working on right now. It's a single lady. She's an ex-school teacher, has a very decent pension. She's in her early 70s, I believe, Blair. And you know, the thing that really gets me is she's in her early 70s. She's got a fantastic home in Thornhill that was valued at about $1.3 million. Yet she still has a $350,000 mortgage on the home. So her desire was to free up that monthly cash flow that she was directing towards that mortgage, replace it, basically reshuffle the debt with the chip reverse mortgage. And now she's able to use that monthly cash flow to invest part of it with you by way of pre-authorized checking plan, a PAC, and use the remaining cash flow to do anything she wants in life and live it up as long as she can.
And that's exactly what this podcast is about, George and Eddie. Like, you guys have really stood out and you know, pointed out just how important it is to have a professional look after you when you go to do any of these things, because nobody knows everything. A lot of people try to do things on their own now. There's all these apps and whatnot, and it's just not the way to go. You have to deal with someone that's experienced and professional and knows what they're doing, is passionate about what they're doing, and that about does it for today. Any closing remarks?
I just want to really thank you, Blair, for allowing me to participate in this podcast, and it was truly a pleasure getting to know Eddie as well. I'm looking forward to working with both of you to help Canadians, your clients, going forward. So thank you again.
Eddie?
No, thank you so much. It's been really fun, George. It's been great, really learning a lot more about this product, and I do think it helps a lot of Canadians, because I mean, it's a challenge that most people are facing. You guys are in the industry even more than I am, because you deal with people's financial situation a lot more closely, and it's safe to say that a lot of Canadians aren't prepared for retirement. They won't have that cash flow. They'll require some sort of a pension that might not be enough, and the only retirement saving that a lot of Canadians have is their home. And it's difficult because they sometimes have to make a decision whether they're going to part ways with their beloved home and go rent or go to a retirement home, but they don't want to. So with solutions like yours, it allows them to stay in their home, to live with dignity, happily, and still be able to afford a comfortable lifestyle without having to pay a high mortgage. So I think it's absolutely fantastic. I commend you for it. I think it's helping a lot of people, and it's important that we spread the word out and bring it to people's attention so they know that there's an option. It's not only selling, it's not only going to a private mortgage or a private lender, which a lot of people do at this point because they can't qualify with income, and you're paying 12-15% interest rate. I've seen as high as that. And right now it's low because the interest rates are low and private lenders are competing. But once this turns around, and it will, you know, the rates are going to start, we're going to start seeing double digits rates for private lending easily. Closing, I'd like to talk just briefly about the market, because you know, I'm getting DMs all the time about what's going to happen with COVID, what's happening with this stay-at-home order. And, you know, you can predict the future very well by looking at the past. And if we saw what 2020 did with the market, I think it's a continuation of the same. December, you were up 60% number of sales month over month, year over year. So the market is incredibly strong. There's a high demand. It's being fueled by the low interest rates. It's being fueled by the pandemic. I've helped tons of families move out of the city into the 905, into Barrie, into Bradford, into Innisfil. That's what people are doing right now. You have a lot of positions where we're able to comfortably work remotely and still make an income. And we don't need to be in the city anymore. A lot of people, that's what they're doing. They're selling their homes in Toronto. They're selling their condos in Toronto. They have enough equity and they can go out and they can get a much bigger home they're more comfortable in. And that's what you're seeing that's fueling the real estate market right now. In January, up till today, I've been very active. Usually January, the first 10, 12 days, you're kind of just making plans as to what's going to happen. You have a listing here and there and you're selling it. But right now, it's this first 2 weeks of January for me personally, and for a lot of my colleagues in the industry, has felt like a typical spring season, spring market. I'm showing homes with 30 offers. Every house that I've sold and has been involved in bidding wars, 12 offers minimum, right? So that tells you the type of demand that's there for a property, for those assets. And I think it's going to continue, right? I'm definitely encouraging anybody that's buying right now with the stay-at-home order to follow the rules, right? You know, just buy if it's essential. I personally have 3 clients that I have to go out and show houses this weekend because they sold their homes and I need to find them something. I can't leave them on the street. I can't say we're not going to do this. That's why we are an essential service. But we are putting new business on hold. And that's what we did in April and March of last year. We put new business on hold. And as a result of that, once the restrictions were lifted, I mean, we've had 2020 was the 3rd highest year on record for number of sales during a pandemic.
Pent up demand. Yep.
Absolutely. Because it started the same way. I remember 2020, January, February was personally record-breaking months for myself before the pandemic. And everything was starting to go like this with number of sales. Same thing I'm telling you right now. So that's why I believe history is repeating itself. I think we're definitely going to see a dip in activity, number of sales for these coming months. But then right after that, I think we're gonna jump back in, and it's gonna be very similar to what 2020 did. So for everyone that's planning, that's the main thing. What I encourage is planification, right? Get the facts. Talk to professionals. As Blair said, there's so many apps that you can do your own research. And I encourage all of my clients to do their own research. I don't want to be their own source of information, but I want to help them interpret it. Because you know what? You can see a bunch of data. I can tell you that 95,000 homes were sold in 2020. Okay, so what? What does that mean to you? If you own a condo downtown Toronto, what does it mean to you? How does that specifically affect it? If you have a 1-bedroom condo or a 2-bedroom condo, what's the difference in that? Because it's a very different market. Actually, right now the condo market's a little bit flat. It's starting to rebound, but it's a little bit flat. So you need a professional to really help you interpret the information. So anybody that's looking to make a move this year, whether it's upsize, downsize, move out of the city, just refinance, whatever your real estate questions are, like I'm very, very happy to help, to approach. I think Blair's going to be sharing our contact info, but they can always reach me on Instagram. That's probably the best way, Eddie Donan, or Facebook, the Eddie Donan team. And obviously my phone number is 647-449-4520.
Yeah, we'll flash those graphics up on the screen as well. So they will be able to contact you. If you want to contact Eddie or George, you can reach me. I will refer you. If you need any advice financially, call our 1-800 number you see now. We will certainly point you in the right direction if we can help you. But we'll do everything we can to make sure that you get what you need. All right, gentlemen. Thanks a lot. George, you're going to be tough to beat next week, but we also have another incredible guest. But you know, it's on them now.
We've set the bar. We've set the bar.
The bar high, George. Set the bar high. And next week, I'm actually going to be doing a case study, because a lot of people are they wonder is it better to rent or to buy? If you can buy, why should you? And I'm just going to look at a case study for clients. I've been doing this for 14 years, so I'm going to show you what difference buying 5 years ago would have made in your life. So I think that's going to be pretty cool.
Awesome. All right. Thanks, guys. We'll see you next Thursday at 6 p.m.